European corporate bonds delivered positive returns in the first quarter of 2024, off the back of continued disinflation trends in Europe and healthy credit demand. As the ECB is expected to cut interest rates ahead of the Fed, European bonds offer a very compelling investment case, especially for dollar-hedged investors. Launched over 25 years ago, the AB European Income Portfolio seeks to maximize income and preserve capital by dynamically balancing higher-yielding assets with lower-risk government bonds. I'm pleased to welcome John Taylor, AB's Head of European Fixed Income, joining us today to share his latest insights on the European market. John, what's your market outlook for the rest of 2024?
Starting in July 2022, the ECB raised rates by 4.5% over a 14-month period, and that has caused a dramatic response both in inflation and growth. Inflation peaked at 10.6% in October of 2022 and has fallen to 2.4% in the last print, and quarterly growth rates have been stuck around zero since the end of 2022, with certain countries experiencing mild recessions. Although a modest rebound in growth is expected in the second half of this year and 2025, general growth weakness will likely persist in the medium term, which provides a strong argument for reducing the degree of policy restrictiveness in the euro area, since the current 4% deposit rates are too high for the European economy to withstand. Let's not forget, this is a region that required negative interest rates for 8 years prior to this current cycle. Our house view holds that the ECB will not only cut interest rates by 100 basis points this year, starting in June, but will continue to cut interest rates well into 2025, whilst we don't expect the Fed to start cutting until December.
So, John, why should investors consider an allocation to the AB European Income Portfolio now?
There are two reasons which I want to highlight. Firstly, the hedging benefit of owning euro-denominated bonds for a US dollar investor. Currently, USD investors can benefit from an additional 1.5% or so from currency hedging. For example, the yield to worst on the AB European Income Portfolio stood at just below 4.5% in euros, resulting in the US dollar hedged yield to worst being close to 6% as at March 31st, 2024. And we expect the hedging benefit to widen in the second half of 2024 as the scenario of the ECB first materialises. Secondly, the cards have aligned for EIP today, and there are opportunities on both sides of the barbell currently. Yields are close to historical highs. However, as the ECB cuts rates, yields should fall. This environment is particularly opportunistic for a barbell strategy like EIP, since there is room for yields to fall in the event of a risk-off or market stress environment. When the ECB starts cutting interest rates, we expect domestic investors to reduce their large cash allocation and increase purchases of high-quality Eurobonds. From a credit perspective, lower rates should support consumer spending and lead to a modest growth recovery. This environment is constructive for corporate fundamentals. We do expect some defaults to increase in 2024, but will still remain within historical averages. And history shows that most defaults occur in CCC rated securities, but we concentrate our high yield exposure in BB and high single B rated issues. In terms of valuations, Euro investment grade has outperformed USIG in recent months, but still trades at a wider spread. Euro high yield spreads are somewhat tight, but yields are still very attractive. On spreads, the market has become more short dated versus history due to a lower supply. Lower duration means lower spread risk. The yield to worst on the Euro High Yield Index is currently above 6%, with an average credit rating of low BB. In comparison, looking back at 2017, even the CCC rated bonds were only yielding 5%.
Lastly, John, how is your portfolio positioned today?
We've added duration over the course of 2024 as yields have increased, portfolio duration at 5.8 years at the end of March. And we're mainly focused on the below 10-year part of the European curve, which should be the most responsive to the interest rate cutting cycle, whereas longer dated bonds offer very limited additional yield. We own UK duration, where the additional yield of UK gilts versus German bunds is at a similar level today as it was last year when the inflation gap between the two regions was significantly larger. Although caution is warranted and picking the right spots in credit is important, overall our current positioning provides us with room to add high yield credit when we see more favourable spreads, whilst benefiting from sufficient protection from duration in times of market stress. Recent focus has been one of de-risking, which means continuing to reduce high yield exposure and increase investment grade. Most of our portfolio activity recently has been in the primary space, predominantly within BBB and BB issuers, where yields and new issue premiums remain attractive. And against these purchases, we have further reduced the best performing single B and triple C rated issuers, therefore improving the overall quality of the portfolio.
Thank you, John. To summarize, it is time to consider an allocation to European bonds due to the divergence between the Eurozone and the US economic cycles. The AB European Income Portfolio can offer the following three unique benefits to investors: balance, quality, and income. Thank you for watching, and see you next time.